Let me bring on board Nooresh as well as Kunal and find out what they're making of the trading structure so far. Of course, we'll have our fundamental expert as well join in just seconds from now. Kunal, what do you make of today's market move? I mean, one thought we could hold on to 19,400, but it's unable to do so at the higher end.
Yeah, but then I think hopefully if we sustain about the 90,400 mark, we could break past about the 50-day moving average. Now that's the more important technical level which I would be watching out for, because historically we've seen that whenever the indices have managed to float or trade above the 50-day moving average after a mild correction or a mild phase where the indices have been trading below this critical moving average, we've seen that the uptrend for the indices typically have resumed. So that would be more of a litmus test for the index. So far, we are holding about that 90,400 mark. And for this trade, I think 90,300 would be a closing based stop loss for the index. So it's a very tight 100-point range which you're talking of, or a 100-point trade which you're talking of. So 90,300 remains to be a stop loss for this long trade on the index.
19,000?
300.
19,300 is the stop loss.
Yeah, for this long trade.
On a scale of 1 to 10, 1 to 10 scale, what are the chances that this time we'll break the range?
It looks like that we would probably break the range on the upside. It looks like
more than 50%.
Yeah, more than 50%.
Okay. Nooresh, it's just been a very yo-yo kind of a market, and frankly, it's not been a market where traders can say that they've got a pronounced trend on the upside and also on the downside. Do you think this week's price action based on yesterday and today is slightly different?
So if you look at it today, we've hit a new all-time high on the small cap index. We've hit a new all-time high on the mid cap index. We are 1%, less than 0.5% away on the Nifty 500. So the case is we are not seeing the move on the index because the heavyweights are not going anywhere. So when you have the whole of IT, then you have Reliance as well as HDFC Bank. Reliance and HDFC are 25% of the index. If they are not moving up or moving down, and you add another 13% from the IT index, then you have Kotak Mahindra Bank and some more heavyweights. There is no trend. But if you look at everything apart from the heavyweights, it's been doing well. So the case here is if the whole, even the Nifty total market cap, which is like 750 top names, is also closer to an all-time high. It's just say maybe almost there today. So in that case, what do we do? Wait for an expectation that we can eventually break out about 19,550, 600. So the bias is positive. You just need one of the heavyweights to actually show a little bit of a move for the upward breakout to take place. So for now, 19,300 becomes a stop loss. Add on the way up about 19,600.
Deepak Shenoy joins us now. Deepak, the market was overbought a month ago. The market is overbought right now, and the market could remain overbought for a month from now. What is the best strategy to deal with this kind of a market where frankly you can argue that valuations are expensive, flows are volatile, but if you're not selling, you are actually making more money?
So, Nikunj, I think the market isn't actually overbought in the sense that its earnings have considerably grown compared to previous year, the same quarter, and you're about at 9. The Nifty P ratio is all wonky because the Nifty, the way they calculate the P ratio is they add up the last known earnings of the constituents. The last known earnings of HDFC Bank did not include the HDFC, which it has now merged with. So HDFC is no longer in the index, but its earnings are not getting considered as part of the Nifty earnings, and therefore P ratio looks a little bit higher than it is. It's about 22 to 22.5, but it's actually about 21 times trailing earnings. I think this is not a very expensive point. So therefore, I don't think it's overbought in any meaningful way. I also feel longer term that the scope for the Nifty and generally the markets in India to go up are tremendously high, simply because in relative terms, we seem to be in better economic shape as a country. Corporates are relatively less leveraged, and overall, I think the triggers coming in the future will be relatively, if inflation were not to spike going forward, it gives the scope for interest rates to correct, and therefore, the economy to get some kind of a respite. But that will probably take a year, for it to show up. Right now, it's only a part of a capex and infrastructure cycle that seems to be moving earnings up at least.
Look at all the hotel stocks, that's where all the action is, right? Indian Hotels is sitting right on top there, 5.5% higher. EIH, etc., also should come off you on your screens. Kunal, what a breakout move on Indian Hotels.
Yeah, very good breakout move for the stock, and I think it's come after almost 3 months, if I'm not wrong, in time month of June, July, as well as good part of the month of August. The stock was into this 20 point, 25 pointer range. 380 or 378 was the support, and 400, 405 as a resistance. So this looks like a very good move, because when stocks go into a 30%, 40% rally, then a 3-4 months of sideways correction, stuck into a 5-6% trading band, that's generally considered to be very healthy for the stock price. And I believe now the stock should see a strong up move. Volumes today also quite attractive, and the biggest part is that this move comes into an expiry week. So if there over the last 2 or 3 expiries there have been, say, short rollovers or traders who are not willing to participate into the stock price, all of that changes on the expiry week, because traders are willing to carry forward positions after you see such kind of a strong breakout for a stock like Indian Hotels. So would be bullish on the stock.
Well, it seems like a case of basket buying. I mean, look at Lemon Tree, Chalet, etc. as well. They too are scaling up higher by about 5% apiece, really. Look at that chart of Lemon Tree hotels today. Chalet as well spiking up by 3%. Lemon Tree was up 5%. So all these stocks are really on a tear as we speak right now, led of course by Indian Hotels, the largest of them all within the listed universe. Well, call it what you may, the upcoming holiday season, or for that matter, World Cup. I mean, clearly all of these stocks are excited. Everything from a Zomato to Jubilant Foodworks too.
See, markets always preempt something which could happen. That's how markets move. Like you always say that don't focus on where the puck has moved, but focus on where the puck would move. Will the puck move in favor of in favor of tourism for next couple of months? Will it be strong for food delivery? If India and the World Cup starts, will there be a binge order for biryani, pizzas and food delivery? The answer to that is absolutely yes. Has commodity inflation started coming down, especially on the vegetable front? The answer to that is yes. Tomato prices, onion prices, have they started coming down? Yes. Milk prices have started coming down. So there is a big case now to buy into commodity producers. There is a big case now to perhaps revisit some of the, let's say, liquor stocks or food delivery companies, or essentially categories which would benefit because of cricket or celebration or festive season. And I think that clutch, would be important. Aisha, there used to be a time when you would say, okay, festival season means more car sales, more AC sales, more clothes sales, more watches. But the uniqueness of this economy is that it is changing. And now celebrations and now holiday season may coincide with just better travel. It may just coincide with, better dining out options. So your basket of consumption, which was, let's say, concentrated only in and around buying white goods, mobile phones, which will continue, I guess is also diverting towards these new categories. And that's where I think the gains, are visible, and that's what markets are telling you.
Yeah, Deepak, what are you making of the aspirational Indian who now wants to holiday more and holiday better, buy better cars and better phones across the board pretty much?
Premiumization, as we call it, it is happening in a meaningful way. I think income levels have gone up, at least for a relatively small percentage of the population, but that is really the India that can be targeted in a meaningful way by most of the players that you mentioned, whether it is cars or food delivery and all of that stuff. It's affordable to about maybe 2% or 3% of India's population per se. So that's that, and the households, about maybe 1 crore households are roughly what it is. But it's actually happening where they are actually pushing the level one level higher, and what used to be a 100 rupee dish is now a 150 rupee dish on average if you're ordering from a food delivery service. And you see the prices of the IPL tickets, or if you see the prices of movies, or you see the prices of whenever they announce it for the World Cup tickets, I think we'll find we will be surprised by how much Indians are willing to pay for entertainment, tourism, and travel. I think it's a very big sector. I think this premiumization is partly coming out of COVID, where incomes got generated but not spent, but also coming out from the fact that the prices of these goods haven't increased in any meaningful fashion, the people have been able to upgrade their income, so they have been able to afford this more. The best-selling Indian car is not the Maruti cheapest car anymore. It's the Tata Nexon uh, on a single brand. So that's also surprising because you'd never think an SUV or a Cross would be the highest Indian selling brand, but it's happening across the board.
In fact, we were just chatting with Shashank Srivastav as well earlier today, and he said that Maruti's inventory levels are sitting at a 4-year high, and it's not the sedans but the SUVs which consumers are making a beeline towards, and of course all their new launches as well. Let's hear out a sound clip of what he told us.
Have certain models which have got excess inventory, sometimes going up to 50 days of stock as well. And there are others where you still have pending bookings. In other words, there is a waiting for those models and therefore very low inventory. Clearly, however, since July, we have seen a uptick in production in even those models which were earlier in short supply. A couple of years have been pretty tight as far as inventory is concerned due to various reasons: COVID lockdown, you had supply chain disruption, semiconductor crisis, and so on and so forth. But yes, the last time we saw this level of inventory of almost 300,000 in the industry was in September 2019. So that's really a 4-year high. But expectedly, because people are preparing for a large retails in the upcoming festive season. So I think that's a normal phenomena where inventory is built up in the channels. SUV has been growing. It has grown from roughly 26% 4 years back to now almost 49% last month. So cumulatively this year it is 47% of the industry. Expected to grow even further coming years, expected to plateau around the 52-53% mark. So it's going, is now the largest segment of the overall market. 2 years we haven't seen discount across any model because all models were in short supply. But as we discussed earlier part of our conversation today, there are some models where you have excess inventory and excess supply, and those are the models where you will see discount.
Okay, what's not looking good today? Interglobe Aviation, that's definitely one stock which is lower. There's Power Grid as well, which has fallen. There's BPCL, which is down about 1.6% along with HP. And there's India Cements, which is down by about almost 2.5% as we speak. The buying has been pretty sporadic. I mean, you can't really pinpoint a trend, but yeah, IT is actually seeing some gains. So both Infi, LTIM, and some of the mid-cap IT names as well are the ones which are showing some buoyancy. What is Reliance up to, considering it was quite the damn squib post its AGM, and that was pretty much the follow-through action? Continues to be flat for RIL, still down, around those 2,400 levels. Deepak, what do you do with RIL? I mean, from the AGM, there were no near-term triggers, always a long-term vision, as it is the case. But what next for RIL shareholders?
So we are an RIL shareholder. So in a sense, we're also part of the people who are looking forward to what's coming next. I think the story here has two parts. One is Reliance's own capex and expansions, and they're doing some in the I think they've mentioned it over there. They've talked about moving more into solar, into generation. There are some updates about what they're doing with green energy. There is also expansions on the retail front and so on. The second part is the demerger. I think the eventual demerger of Jio, the telecom business, and retail, the retail ventures, which is the retail business. I think that will be a trigger for Reliance to kind of break out of this zone. It's going to take some time. I think right now, until they show it or demonstrate in the results, they've actually ended up with about 75,000 crore of capex. That financing of it will be now at a higher rate compared to what it was. But when Jio Financials actually starts operations, that might stabilize a little more. So it will take about a few more years before a lot of these announcements come into play. I think one has to think about it longer term. In the short term, I don't see anything meaningful, unless of course tomorrow they unveil something on AI, which is dramatic or something. They talked about it, but I haven't seen anything actually out there that's visible yet. So I think I'll wait. We have a large position in it, but we're willing to wait a long term for it.
We've been highlighting OMCs and the fact that they're a big drag on today's markets. But Nikun just had a conversation with Petroleum Minister Hardeep Singh Puri, and he talks about crude prices and the status of OMCs amid the cut on LPG prices.
The price of crude oil is determined by a global situation. We are dependent up to 80% of our requirements on imports for crude oil, about 55-60% on the import of natural gas. Our OMCs incurred a loss of 28,000 crores. Now, they are not operating on their own money, they raise money in the market. So you had to compensate them. So that 28,000 crores was compensated up to an extent of 22,000 crores. If you are to insulate the common man, I mean the economically weaker sections, the people who live below the poverty line, then both the government and the OMCs will have to do it. It's not as if the OMCs are collapsing. I can say with a degree of satisfaction that the OMCs today have registered very reasonable and healthy financial results. I'm choosing my words carefully. There are quarters when they do better than other quarters. But I think when the Prime Minister decides that the price of a cylinder, a 14-kilo cylinder has to come down on the occasion of Onam and Raksha Bandhan by 200 rupees, the OMCs are happy, the country is happy. OMCs have large businesses. Some of them make big profits in a quarter, some less. But they're all doing reasonably well.
List of winners and losers today. And today, for a change, you don't have the defense names which are doing something special. They're not doing cartwheels. BHEL has moved independently of what's happening in the mid-cap space today. That's BHEL for you. It's chugging along very, very smartly. But I want to look at defense stocks, HAL, BEL, BHEL, Mazgaon Shipyard, Kochi Shipyard. That entire cohort of defense stocks today are not participating, if at all. I think they're reversing from the day's high. Cochin Shipyard is a reversed. And Mazgaon Shipyard, which is up, what, 100% in last 1 month, Kunal? The YTD change, sorry. YTD change for Mazgaon Shipyard is 130%.
That's more than 100%, correct.
Right? Where's Mazgaon Shipyard? Let's look at it. They're still making ships. They have not started making aeroplanes. Aeroplanes are still made by HAL. I don't know why do markets get confused. But the way the stock has gone up, it's just been an amazing run. Zomato, 100 rupees, hit a century. The overhang of SoftBank and the stake sale from Tiger Global, that seems to be getting diluted now. Fresh buyers have entered. Old investors have exited. Almost at 100 rupees last when I checked. I mean 99.85. You may want to call it 100. But on the Nifty now, you have a very sharpish kind of a reversal led by the Bank Nifty and led by HDFC Bank. And once again, Nooresh, HDFC Bank has disappointed.
So it just continues to be a stock which has been at the same price for almost now, if you look at today's price at 1580, 1590, it is where it was in say 2023 of May, 2021 of say May, June. So the last time the stock was at 1590 was back in Feb, March of 2021. So the stock has gone nowhere for the last 2 years now, or even more than that. And we don't have a trend on HDFC Bank. And this continues to be 13-14% of the Nifty. And that is where the problem is. We don't get a trending move till the time we don't get at least one of the heavyweights to do well. The only case is it's not breaking down as well. So the last time we saw a big gap up move on the stock last year was when it gapped up from 1550 and went towards 1600, 1650 levels. The dip in March also this year was closer to 1530, 1550. So the trend does not become weak till the time we don't break 1530 levels. And on the upside, till the time we don't break 1700, 1750, the longer term trend does not change. So in the short term, disappointing. In the last two and a half years, been sideways. And even going back to pre-COVID, the returns are not great. The stock used to be 1250, 1300 in 2019 to 2020. So it's been a major underperformer. How long does it stay is difficult to stay. The last few times it came to 1700, there were hopes. So for now, we'll wait whenever it crosses 1700. That's the time to look into it, or say if it breaks 1530.
Let's look at what Zomato is up to. Remember earlier today, you had 10 crore shares change hand in a block once again. SVF Growth Fund is the likely seller that's being talked about. Zomato is now almost nudging that 100 level. Or Kunal, did it touch it intraday today?
Yes, it crossed 100.
Crossed 100?
Yes.
What next then on the cards? It's already a triple digit stock.
So we discussed this, I think, yesterday in morning, and I was mentioning that this could be a fresh wave of up move for Zomato. And in this leg, I would expect 120 as a target for the stock price, and that's a retracement or rather an extension, Fibonacci extension target for Zomato. So, the pause which had happened for the stock at 104 levels was almost a 61.8% retracement, a classical retracement. And from a classical level over there, the stock fell back towards 88, 89 mark, which is again a major retracement support, 23.6% retracement. So when in terms of that extension chart, the next targets for the stock is around 118.9, which means closer to 120 is where I would look out for a target on Zomato.
Okay, from Zomato, let's move on to the auto sector. And the government, it seems, has agreed to the long pending demand of the auto sector to extend the PLI benefits by another year. In fact, we're learning from our sources that the government has also agreed for quarterly disbursement of incentives for better fund flow. Samir Dikshit, my colleague, joins in with all the latest. Samir, what are you picking up from your sources?
Giving a big boost to the auto PLI, the incentive-based scheme for the automobile sector, the government has agreed to give an extension of 1 year for this scheme. The scheme which was rolled out last year in the year 2022 was there till 2027, and now the government has decided to give an extension of 1 year and it will be there till the FY 2027-28. With the extension of 1 year, government understands that this will help to attract more investment from the auto players, and not just this, the investment part, but also the scaling up of manufacturing capacity as well. The auto players will be encouraged to enhance their manufacturing capacity. Moreover, this will also attract the new technology in the entire sector. So, based on the feedback and also the request from the auto players, the government has agreed to give an extension of 1 year to the entire auto PLI scheme. And not just this, another bold decision that government has taken based on the request from the auto players, the government has decided to disburse the incentive quarterly rather than the current structure. Currently, the incentive is disbursed annually, but now government has agreed to disburse the incentives quarterly, and government understands that this will help to boost the morale of the auto players or those players who are beneficiary of the PLI scheme. So this entire PLI scheme, which is having a quantum of around rupees 26,000 crore as an incentive-based scheme, currently it has got 18 applicants. More applicants are likely to join, are likely to submit their proposal for the DVA, the value addition certificate. And government understands that this will also help to generate more jobs in the country.
Deepak, what's been your last purchase in this market, and where are you looking at exiting completely because you think the valuation or the template is now shaky?
So we generally don't get out on just valuation alone. The business has to have some kind of a negative trigger going forward. I think we've just pared down at this point because certain stocks have run up a little bit and they've breached our upper levels of percentage ownership. But right now, we've not exited much. To be honest, we've added, a few players, we're still buying them, so I'm not going to name a lot. We're doing something in the digital entertainment space. We've added a lot more in terms of both public sector and private sector players in the electronic manufacturing space. We've added some players in the defense and rail spaces. The idea here is, of course, that India's move to import substitution will benefit these companies disproportionately. In the process, I think the last few months, the only exit that I've really had is, I think, Siemens, because of some corporate governance issue which we weren't very fond of. Of course, that is now behind us because they've cancelled that sale of a unit to their promoter. But once you've told us what the intention is, it's not easy for us to kind of go back in there and say, well, it'll be okay the next time. So that's we've just been adding very little churn these days. Markets have been kind. So, but I'm actually looking forward to a couple of more sectors. There seems to be a turnaround in textiles. There seem to be something happening, early stages happening in chemicals. So looking forward to some of that. We may end up replacing some of our stocks if we see a 3 to 5 year trend, especially in the special situations that we have. I think a 3 to 5 year trend will be a good thing to kind of switch now. There, I mean, we haven't taken the decisions yet, but research is on, especially in these two spaces.
Kundan, just today at 9:30 a.m. from Tata Chemicals. Let's listen in as to what he's saying about the longevity of this uptick that one is seeing in prices.
Our view is that the demand is going to increase to almost 80 million tons, and there's about 4-5 million tons coming in capacity. We need to bring more capacities on stream, and we will continue to maintain a very balanced approach to this market because customers need the material, and we need to bring that on stream. That's it. We made two bets which were coming out of our lab in the area of nutrition, and another one in the area of silica and rubber chemicals. And what has happened is the rubber chemicals and tire chemicals has played out positively. And we are taking a longer time to build our prebiotics portfolio, which has been fundamentally taking longer than what we would have anticipated. It's just we bought stake up to the level permissible by the stock market, by the regulator, which is about just below 5%. And I think the rationale remains the same as exactly as we had held before. And the idea is to build a very strong specialty engine for Tata Chemicals, and Rallis offers that platform within the Tata Group. And we've had to sort of fix some of the issues on the ground, especially with the seed business. But I think that is behind us more or less.
Well, just in case you were wondering that it's turning out to be not bad a day for equity markets, look at the Nifty because it's completely given up all of its gains. We're at 19,374, pretty much where we left it off yesterday. What's turning the tide for the markets? It's banks once again. SBI is now down over 1% in the futures. ICICI Bank, and look at the intraday graphs because that massive chunk of selling has really come in the last half an hour or so. ICICI Bank is back to 960 odd levels. Similar is the price action with the Kotak, HDFC, which are now drifting lower and lower as we speak. Reliance as well in the red. It was just flat a short while back. And there's L&T as well, which is mildly soft. You can skip L&T. It's been a rank outperformer. But yeah, private banks and, Reliance has been the one which is weighing heavy on the markets. Even L&T, the fall has really come in the last quarter, 1 hour or so. Europe, by the way, has started off a little wobbly, one must say. You've got DAX, which is down about 0.5%, CAC as well lower by 0.5%, and the broader stock 600 index as well is marginally soft as we speak right now. Just want to see what the pre-market rates for US futures as well are. While they are little changed, so flattish but with a negative bias, and this is after a strong handover that we had overnight yesterday. But Nooresh, just wanted to check on the Nifty Bank because that's the one which is looking like the weakest link right now.
So the Nifty Bank, as we see it, the cases, two of the largest weights are HDFC Bank and ICICI Bank. Both have been sideways for quite some time now. So after breaking out into a new all-time high at 960, ICICI Bank has seen no follow-up price action. Same is the case with HDFC Bank. It stays around 1600 plus minus 20 points. And then when we look at Bank Nifty, the lows for May, June were closer to 43,500. The August lows were around 43,600. The highs around 45,000. So we are stuck in this band right now. We saw recovery in the last two sessions from 44,000 levels. So we are right in the middle of the range. So till the time we don't break 44,000 or 45,000, it's tough to take a trading, a trending view as of now. But the bias is positive because the overall banking space, apart from the heavies, is still pretty positive. So for now, it's a buy with a stop loss with 44,100 as a stop loss on the Bank Nifty.
Let's take in some closing ideas as well. Nooresh, you only go first. What is it that you're going to recommend?
So that would be a buy on Indian hotels. The stock has hit a new 52-week high as well as a new all-time high. Could see more follow-up action over the next few sessions.
Kunal, what about your closing strategies?
That'll be a one. Tata Steel, after quite some time, the stock has broken past about this 118-19 barrier. So would suggest a buy. In fact, look out for Tata Steel as a closing bet and look out for targets close to 130.
Deepak, chemicals coming back, pharma coming back, metals coming back, but China is not coming back. Anything which China consumes is coming back. How unrealistic is this, right? The consumer market which consumes metals, chemicals, pharma, API, that economy is not coming back, but the stock prices and inflationary trends have come back. Why is that?
It's a good question here. I think it's China is a competitor in the exports of all of these things as well. So it's one of the largest exporters of metals, steel. I think China exports more than the next 5 countries combined, or produces more than the next 5 countries combined. So while it is a consumer, it's also an exporter. When consumption reduces in China, the players who actually produce this stuff will actually increase their exports, and if there's demand, of course, that will potentially crimp growth of any other player in this space. But I generally feel that China isn't a big importer other than from Australia and perhaps Japan. It doesn't import much from India, for instance. So their slowdown affecting us is going to be much more downstream. So it will have to affect another country, and then that country will have to impact us per se. So I think at some level you're seeing some prices go up, but I don't know how sustainable they are, especially of all the commodity level elements. I also believe that we're probably in a period of flux right now, because US interest rates and Japanese interest rates, more importantly, will determine the state of the world economy. And India might not get so badly affected, but we may get hit in the crossfire if rates go up tremendously abroad. So I don't think it's the right time to make that decision on China. But China has other problems on debt and stuff like that, and that can affect, again, it will take 2 layers before it affects us. Most of the Chinese debt is owned internally. I would say right now, look at China only from that debt market explosion or implosion kind of a view, not really from a demand kind of a view. Its demand is not going to change things meaningfully for Indian exporters or Indian producers.
Deepak, great to have you on the show. We'll let you go on that note. We are talking about a cool-off in the market. Just want to bring up what Jio Financial Services as well is up to. Remember, as of yesterday, it was locked in upper circuit for a second consecutive day, and nothing changes today as well. Still locked in that 5% circuit, 231 plus levels. Remember, we were the first ones to tell you that founder firm Jamnagar Utilities bought 25 million shares, each in BSE as well as NSE, as of yesterday. In a bunched trade, and that stock continues to hold high. On that note, we're going to take a very quick break. When we come back, we'll track the last half an hour of trade this afternoon.